On Wednesday, the 8th of March, 2023, Silicon Valley Bank was one of the most trusted financial institutions in America. It had $210 billion in assets, a 40-year track record. Half of all venture-backed technology and healthcare startups in the United States banked with it. CEOs, founders, venture capitalists, the entire engine room of American innovation trusted SVB with their money. By Friday morning, it was gone. Not because of a fraud, not because of a rogue trader, not because anyone stole anything. It collapsed in 48 hours because of a single miscalculation, one that almost every other bank in America was also making. And when it fell, it triggered the worst banking crisis since 2008. 3 major banks failed in 6 weeks. The US government intervened at emergency speed. And a Senate investigation later concluded that the regulators watching over SVB had seen the warning signs and ignored them. This is the full story of how Silicon Valley Bank died, and why it matters to every single person with money in a bank account. Before we get into what happened, let's be clear about why this story is relevant to you personally. Most bank collapses are abstract, numbers on a screen, headlines you scroll past. The SVB collapse was different. It was visceral. On the morning of Friday, the 10th of March, 2023, thousands of startup founders woke up and discovered they could not access their company's money. Companies like Roku had $487 million sitting in SVB. Roblox had $150 million. Vox Media, hundreds of British tech companies, all locked out. The immediate fear, the one that spread through Silicon Valley within hours, was payroll. If you can't access your bank account, you can't pay your staff. That Monday was payday for thousands of companies. If the government hadn't intervened over the weekend, Monday the 13th of March, 2023 could have seen tens of thousands of tech workers go unpaid. In the UK, the situation was equally alarming. SVB's British arm held billions of deposits from UK tech startups. By Monday morning, HSBC had agreed to acquire the entire UK operation for £1. £1, not a billion, not a million, £1. The Chancellor of the Exchequer, Jeremy Hunt, confirmed the deal had been arranged overnight to protect UK depositors. But here's what I really want you to understand about this story. The collapse of Silicon Valley Bank wasn't caused by some exotic financial product that only experts could understand. No credit default swaps, no subprime mortgages, no hidden leverage. It was caused by government bonds, the safest possible investment, the kind of thing every financial advisor tells you to hold. And that is what makes this story so important. If SVB could collapse holding the safest assets in the world, what does that say about the banks holding your money? To understand how Silicon Valley Bank died, you need to understand what made it special. The bank was founded in 1983 in Santa Clara, California. The founding story is wonderfully Silicon Valley. Legend has it that the idea was hatched during a poker game between a group of businessmen who saw a gap in the market. The gap was this: the major banks, Bank of America, Wells Fargo, Citibank, didn't understand technology startups. They looked at a young company with no revenue, no assets, and no track record and said no. No loan, no business account, go away. But the people who ran those startups needed banking. They needed payroll accounts, lines of credit, somewhere to put the venture capital money when it arrived. SVB positioned itself as the bank that understood tech. It hired bankers who could read a pitch deck, who knew what a runway was, who understood that a startup losing money in year 1 might be worth $1 billion in year 5. The model worked brilliantly. SVB didn't just offer banking services. It embedded itself inside the startup ecosystem. Its loan agreements required borrowers to keep all of their accounts at SVB. Your venture capital funding came in, it sat at SVB. Your salary payments went out from SVB. Your company's entire financial life ran through SVB. In return, SVB took bets on companies that no traditional bank would touch. It financed the early stages of companies that would go on to become household names. It built relationships with the venture capital firms, the Sequoias, the Andreessen Horowitzes, who funded those startups. And because every company those VCs backed was told to bank with SVB, the bank grew alongside Silicon Valley itself. By 2020, SVB had been doing this for 37 years. It had $60 billion in deposits. It was the 16th largest bank in the United States. It was profitable, well-regarded, and deeply trusted by the tech community it served. It was, by any measure, a success story. Then the pandemic happened, and success very quickly became SVB's biggest problem. In 2020, the world went into lockdown, and something extraordinary happened in the technology sector. With interest rates at historic lows and governments pumping trillions of dollars into the global economy, investors flooded into tech. It was the only sector that seemed to thrive in a pandemic: remote work, e-commerce, streaming, cloud computing. Every metric was going in one direction. Venture capital investment in U.S. startups in 2021 hit $329 billion. To put that in context, that was more than double the previous record. And because every one of those funded startups was told to bank with SVB, or already banked there, all of that money flooded into SVB's deposit accounts. Between 2020 and 2021, SVB's deposits tripled, from $60 billion to $189 billion in approximately 18 months. That is one of the fastest deposit growth rates any major bank in American history has ever experienced. Now, think about what happens when a bank receives $130 billion in new deposits. It needs to do something with that money. Banks don't just sit on cash. They invest it, typically in loans and securities, and earn a return. That return is how they make money, pay staff, and stay in business. But SVB had a problem. Its startup customers didn't need many loans. They had just received hundreds of millions in venture capital. They had more cash than they knew what to do with. So SVB couldn't deploy the new money into its traditional business of lending. Instead, SVB's leadership made a decision that would prove catastrophic. They took that $130 billion and invested it in long-dated government bonds and mortgage-backed securities. On the surface, this looked conservative. These were the safest assets available: U.S. government bonds, backed by the full faith and credit of the United States. You cannot get a more dependable investment. But there was a catch. SVB bought these bonds when interest rates were at near zero. The bonds paid around 1.5 to 1.8% annual interest. And because SVB needed slightly higher yields, they bought long-dated bonds that wouldn't mature for 10 to 20 years. The Federal Reserve's official review, published in April 2023, noted that SVB's management were focused almost entirely on short-term profits. They were not stress testing against the scenario that now seems obvious in hindsight. What if interest rates rose? In 2021, SVB's management looked at inflation and decided it was temporary. The Federal Reserve had been saying the same thing publicly. Most economists agreed. They were wrong. All of them. In March 2022, the Federal Reserve began raising interest rates to combat inflation. What followed was the most aggressive rate hiking campaign in 40 years. By early 2023, the federal funds rate had gone from effectively zero to over 4.5%. A move that had taken the Fed decades to make in previous cycles was compressed into less than 12 months. Here is what that did to SVB's bond portfolio. When interest rates rise, existing bond prices fall. This is a fundamental, unbreakable law of finance. If you own a bond paying 1.5% interest and the market now offers 5%, no rational investor will pay full price for your bond. They'll only buy it at a discount, large enough to make the effective yield competitive with what's available elsewhere. SVB's $80 billion bond portfolio, bought at near zero interest rates, was now worth significantly less than they'd paid for it. The paper losses mounted into the tens of billions. By the end of 2022, SVB was sitting on approximately $15 billion in unrealized losses. Losses that didn't show on their published accounts because they hadn't sold the bonds. Under U.S. accounting rules at the time, banks weren't required to mark these losses to market unless they sold. As long as SVB held the bonds to maturity, the losses were theoretical. The bonds would eventually pay out in full. The bank was technically solvent. But at the same moment that SVB's bond portfolio was quietly hemorrhaging value, something else was happening to its deposit base. The tech boom was over. By 2022, rising interest rates had killed the venture capital party. Investors who had been throwing money at startups at valuations that would have seemed insane 2 years earlier were now pulling back sharply. IPOs dried up, funding rounds collapsed, and the startups that had raised hundreds of millions during the boom were now burning through their cash reserves, drawing down their SVB accounts to pay staff, rent, and suppliers without being able to raise new funding to replace what they were spending. SVB's deposits, which had tripled in the boom, began to fall. Between the first quarter of 2022 and early 2023, deposits fell from $198 billion to around $173 billion, a drop of $25 billion. And here is where the trap snapped shut. To cover withdrawals, SVB needed liquid cash, but their cash was tied up in long-dated bonds worth less than what they'd paid. To raise cash, they'd have to sell those bonds and crystallize the losses. By early 2023, SVB was quietly failing its own internal liquidity stress tests. According to the Federal Reserve's postmortem, SVB repeatedly failed these tests from July 2022 onwards. Management's response was not to fix the problem. It was to change the assumptions in the stress tests to make the numbers look acceptable on paper. The regulator knew. The Federal Reserve had issued SVB 31 supervisory findings, essentially formal warnings, between 2021 and 2023. Not one of them was acted on with sufficient urgency. Silicon Valley Bank was a time bomb, and everyone with access to the information could see it. Nobody defused it. By February 2023, Moody's, one of the world's most influential credit rating agencies, had quietly notified SVB that it was considering a downgrade. A downgrade would make it harder and more expensive for SVB to raise money. SVB's management faced a choice. They could quietly manage the situation behind closed doors, or they could get ahead of it by raising new capital, selling shares to bolster their balance sheet, and disclosing the bond losses publicly. They chose to disclose. On Wednesday, the 8th of March, 2023, SVB made two announcements simultaneously. First, they had sold $21 billion of their bond portfolio at a loss of $1.8 billion. The largest loss any bank had publicly declared in recent memory. Second, they needed to raise $2.25 billion in new capital to shore up their finances. The announcements were meant to be read as a controlled, orderly response to a manageable problem. What happened instead was a catastrophe of communication. The announcement landed in the middle of a market already on edge about regional bank stability. Investors read the $1.8 billion loss and the simultaneous request for $2.25 billion in new capital and drew one conclusion: SVB is in trouble. SVB's stock fell 60% in a single day. The capital raise collapsed. Investors who had verbally committed pulled out within hours. But the most destructive part of what followed didn't happen in the stock market. It happened in a group chat. Peter Thiel's Founders Fund, one of the most prominent venture capital firms in Silicon Valley, made the decision on Thursday, the 9th of March, to withdraw all of its deposits from SVB, and it told its portfolio companies to do the same. Founders Fund was not alone. Coatue Management sent urgent instructions to every startup it had invested in. Union Square Ventures did the same. General Atlantic, Y Combinator. Within hours, hundreds of startup founders were receiving direct messages, emails, and Slack notifications from their investors telling them to pull their money out of SVB immediately. This was Silicon Valley's fatal flaw, the very feature that had made SVB so successful for 40 years. Its depositors were not anonymous retail customers spread across millions of unconnected accounts. They were a small, extraordinarily well-connected community. Everyone in the same group chats, following the same people on Twitter, attending the same conferences, trusting the same voices. When those voices said get out, everyone got out at the same time. On Thursday, the 9th of March, 2023, customers attempted to withdraw $42 billion from Silicon Valley Bank in a single day. $42 billion. In 10 hours. No bank on earth could survive that. SVB tried to raise emergency cash by borrowing from the Federal Home Loan Bank. It wasn't enough. By Thursday evening, SVB had a negative cash balance of $958 million. It was insolvent. At 11:11 in the morning on Friday, the 10th of March, 2023, California regulators walked into Silicon Valley Bank's offices in Santa Clara and shut the bank down. The Federal Deposit Insurance Corporation, the FDIC, was named receiver. It was the third largest bank failure in U.S. history, the largest since Washington Mutual in 2008. The FDIC made a record withdrawal of $40 billion from the U.S. Treasury General Account, many times larger than any previous draw, as it seized control of the bank's assets. 88% of SVB's deposits were uninsured. The federal guarantee only covers up to $250,000 per account, and most of SVB's clients, tech companies with millions sitting in their accounts, were well above that limit. For thousands of businesses, there was no immediate guarantee they would ever see their money again. What followed was one of the most intense emergency response weekends in American financial history. Treasury Secretary Janet Yellen, Federal Reserve Chair Jerome Powell, and FDIC Chairman Martin Gruenberg worked through the weekend under enormous pressure from the tech industry, members of Congress, and the White House. The dilemma was excruciating. The standard approach for a bank failure: let uninsured depositors take losses as a warning to others not to take reckless risks, would have been devastating. Thousands of companies couldn't make payroll on Monday. The collateral damage would spread far beyond Silicon Valley. But bailing out wealthy tech companies and venture capitalists with taxpayer money would be deeply controversial. The politics were toxic. The solution they reached: protect every depositor, insured and uninsured, by invoking the systemic risk exception. The losses would be covered not by taxpayers, but by a special assessment on other banks. On Sunday evening, a joint statement confirmed all depositors would have full access to their money starting Monday morning. In the UK, a parallel emergency had unfolded. SVB UK held billions in deposits from UK tech companies. By Monday, HSBC had agreed to acquire it entirely. Price: £1. The UK Chancellor confirmed all UK depositors were protected, at no cost to British taxpayers. But the crisis wasn't over. 2 days after SVB's collapse, Signature Bank, a New York lender with significant crypto exposure, also collapsed under the weight of a deposit run triggered by SVB's failure. Then, in April 2023, First Republic Bank, one of America's largest regional banks, was seized by regulators and sold to JP Morgan Chase after losing over $100 billion in deposits. 3 major bank failures. 6 weeks. The worst banking crisis in 15 years. And at the center of all 3 failures, the same basic problem: too many long-dated, low-yield assets, too many uninsured depositors, too little oversight from the regulators paid to prevent exactly this. In April 2023, the Federal Reserve published its official postmortem on SVB's collapse. Its conclusions were striking not just for what they said about SVB, but for what they admitted about the Fed itself. The report identified 3 parties responsible for the failure. First, SVB's own management. The bank had actively mismanaged interest rate risk. It had bought long-dated bonds in a low-rate environment without adequate hedging. It had removed interest rate hedges in 2022, at the precise moment it needed them most, because keeping them was reducing short-term profits. And when the stress tests showed problems, management changed the assumptions rather than fixing the bank. Second, SVB's board of directors. The board had failed to exercise adequate oversight of the risks management was taking. SVB did not have a permanent chief risk officer for much of 2022, arguably the most critical year in the bank's history. Third, and most remarkably, the Fed blamed itself. Federal Reserve supervisors failed to take forceful enough action, wrote Michael Barr, the Fed's own vice chair for supervision. The Fed had issued SVB 31 supervisory findings between 2021 and 2023. The problems were documented, the risks were visible, and the supervisors did not escalate with urgency. In 2025, a Senate investigation went further. It called out KPMG, SVB's auditor, and also the auditor of Signature Bank and First Republic Bank, for inadequate audit practices at all 3 institutions that failed in 2023. KPMG had signed off on SVB's accounts just weeks before the collapse. Nobody went to prison for the collapse of Silicon Valley Bank. The CEO Greg Becker and other executives were later banned from working at FDIC-insured banks and ordered to pay back millions in compensation. But no criminal charges. The venture capitalists who triggered the bank run faced no consequences whatsoever. Peter Thiel's Founders Fund withdrew its deposits before the run, protecting its own money while accelerating the collapse for everyone else. Legal? Yes. Ethical? That is a question Silicon Valley is still arguing about. So, what did we learn? After the SVB collapse, the Federal Reserve proposed new rules requiring mid-sized banks to hold more capital and conduct more rigorous stress tests. Those proposals have been debated, watered down, and disputed ever since. The FDIC considered raising the deposit insurance limit above $250,000, particularly for business accounts. That proposal has not been enacted into law. The social media dimension of the bank run, the way a group chat between venture capitalists could trigger a $42 billion withdrawal in 10 hours, has not been addressed by any regulatory framework, because there is no obvious way to address it. What actually changed after SVB? Mostly awareness. Banks and their regulators now talk more explicitly about interest rate risk and deposit concentration. Mid-sized banks face somewhat more scrutiny than before, but the fundamental conditions that allowed SVB to fail, a bank holding long-duration assets funded by flighty, concentrated, largely uninsured deposits, still exist at institutions across the banking system. The 2025 Senate report made clear that lessons from 2023 have only partially been learned. Here is what I keep coming back to when I think about the SVB collapse. SVB didn't fail because of greed. It didn't fail because of fraud. It failed because of a combination of ordinary human optimism, institutional complacency, and a regulatory system that was too slow to act on information it already had. The bank's management believed rates would stay low. The Fed believed inflation was transitory. The auditors signed off. The regulators issued warnings but didn't force action. Everyone was wrong in the same direction at the same time. And that, more than any individual decision, is what makes the story so unsettling. Because it could happen again. It will happen again. The question is which bank and when. If you found this video useful, subscribe to The Paper Trail. We cover the stories behind the biggest financial events in history, the ones that affect your money, your job, and your future. Next week, the 2008 financial crisis. The decisions made by people who absolutely should have known better. Because at least SVB's management had the excuse of inexperience with a once-in-a-generation rate cycle. The people who caused 2008 had no such excuse. Subscribe now, and we'll see you next week.